And it gives me great pleasure to introduce Mr. Santosh Navlani, who's the COO of ET Money and a well-known voice in the industry. In his previous engagements, he was SVP at DSP BlackRock Mutual Fund and had co-founded Money Sites, an investment decision-making tool. He frequently shares his insights on wealth management on the ET Money show. And today, he's here to talk to us about the value factor. What is so exciting about the value factor? What does it mean to be investing in value through an index fund approach? So, without further ado, please join me in welcoming Sanjay. Please join me in welcoming Santosh here. Hi, Santosh.
Hey, Shankar. Hi. Good to be here. Looking forward to sharing my views, and I'm sure in the question answer session, we'll probably learn and exchange some notes there.
All right.
So I think Anish's presentation was much more meaningful, I guess, from perspective of understanding factors. I would rather skip the factors aspect because I'm sure a lot of people attending this probably would have heard about factor-based investing. I will try to jump to possibly the fact that how value as an investing concept can be approached via factors and not really relying on human biases, which possibly Anish talked about. So, can you go next slide, please? Yeah, so this is one of the slides I basically picked up from one of the Motilal Oswal's presentation itself. I think if we look at value investing, it's possibly one of the oldest methodologies to invest in the markets. Everybody loves and tries to preach that one has to buy at low prices and exit at higher prices. Buy low, sell high is the fundamental mantra which everybody as an investor wants to practice, be it retail or institutional in that. And you create alpha by buying cheap and exiting at higher price. But ultimately, the value, what exactly it is to me as an investor, what is to a buyer or a seller, ultimately differentiates, because for every trade which is happening, the seller actually believes that the value that one is getting or the price the security is trading at that point of time is right now more than the intrinsic value, and hence the seller is selling, but the buyer who's buying actually thinks that it is cheap deal and at a price that I can make more money from. So ultimately value lies in the eyes of the beholder, as they say, right? So but when it comes to investing, it's all about buying stocks below the intrinsic value that possibly we can go and find out, and patiently holding on to the investments, giving time to it, let the market realize the value, correct course, correct the mispricing it may be going through, or lies the potential in the future. In that sense, one has to be patient in value investing. There is no way, as we have discussed in the previous session, value investing has actually not performed for over 10 years now. And the time may be coming, time may not be coming. Nobody can know the future. But the fact is, one has to give time and patience to it. And ultimately, when a time comes where you believe that the price is reached and one can actually start to exit or trim down the positions and create that alpha for oneself or the value for oneself in terms of profit. Can you go to next slide, please? Yeah, next slide. If you just open the entire thing, yeah. So as we said, it's basically it's one of the most simplest concept, right? Buy low, sell high. But very rarely people realize the ultimate outcome of this entire exercise, where I buy at a cheaper price and sell at higher price. It is not that successful. Many people are not able to do that. If that was true, then we would have possibly seen a lot of actively managed mutual fund outperform the markets, and that has not been the case, be it in terms of diversified large cap space or that for that matter value investing as a theme itself. So because everybody practices different approaches to value, somebody would actually look at while looking at value-based investing approach to find out the interesting value in a stock, as a fund manager, one may and look for competitive advantages the company has in the marketplace, or the management commentary about the future, or the kind of quality of the management team one has, or the brand value, or the pricing power. One would possibly go and justify multiple reasons to call a stock a value buy, even if it may not be fitting into traditional definition of value per se. So because people have different kind of definition or perspective or subjectivity around the value as a word, I think if we go and talk to many people, everybody will have different concept about it. So but there is possibly one way where one can simplify it. It's not about buying cheaper stocks, it's about buying good stocks cheaply in that sense. So it's not that one is going and hunting for bargains and saying that let's go and buy this stock because the PE value or the PB value or any kind of valuation metric looks way too cheap to buy. You may get into value trap because of it. So the key over here is you have to first understand the universe that you're looking for in the companies actually has good quality companies, and then possibly apply value. Otherwise, you might fall into the value trap itself. If you go to next slide here. Yeah, so I was looking at some of the data of the actively managed value theme funds, and if it's not much, not many options are available. But if we look at over a decade or so, I think there are about 10 odd funds in the marketplace on value theme in mutual funds, and about 8 of them have outperformed the market over a decade or so. But the moment you look at last 5 years performance or last 3 years performance, most of these funds have failed to beat Nifty consistently. And one can find a question that basically that even if one is practicing value investing as a theme or as an idea where one is supposed to buy companies at low prices and exit at higher prices, still the fund may not able to outperform. It possibly makes us question that if it is not happening in value investing as a theme, it is not happening in large cap space as a theme, then do you really kind of practice this amazing way to invest through some kind of mathematical modeling, which we believe is factor investing in that sense? Can factors be relied more to identify value picks than actually human beings? And while there are, we talked about quality, I think Anish touched upon momentum as well. We have seen the performance of alpha or low volatility as well as multiple factors. The fact is, if mathematical modeling can give us one thing, is basically moving away from human biases. And we have all seen how Jim Simmons has actually outperformed over 2 decades with an unbelievable 66% CAGR on falling factor-based investments. So if we can apply factors, one of the big things that we'll probably achieve is remove the human biases, I think, which is the biggest thing in terms of investing success. The data we are talking about, that 9 or 10 funds have beaten Nifty and Nifty 50 and Nifty 500 over a decade in the value theme funds. But if you come to kind of recent performance, only 3 out of 12 out of in past 5 years have beaten, and I think number is about in last 3 years looks about 8 out of 14. So it's visible that the be it value theme or be it diversified mutual funds in the large cap space, what is happening is the behavior or the phenomena of mean reversion ensures that one is not able to find consistent outperformer over a long period of time. And I think factor-based investing approach actually helps us at least identify a consistent approach to investing free of human biases and subjectivity involved there, and possibly gives us a more of a probability of a steady performance over long periods of time. We go to next slide. So we talked about it. One of the biggest thing that why factor-based value investing has a higher possibility of working in real context is because it's rule-based, right? There is how I select as a fund manager or as an index provider or as a factor fund manager, how I select the securities or the stocks into the portfolio goes through some kind of standard methodology. It's not that if the fund manager changes, I change my view how I pick up a stock. The once the universe is identified, what kind of company set you're going to look for to identify your top value picks, there is a methodology to this entire thing. It may be PB, price to sales, EV to EBITDA, or for my dividend yield as in developed markets is there. If I can, as a fund manager, select a standard methodology to this and put a mathematical formula, then there is a high probability that I would possibly be more consistent in my approach to managing the money than actually having the whims and fancies of the market dictate my terms. And second aspect is allocation as well. I think the science also lies in how do you really position size your picks in the entire thing. What kind of allocation your stocks are getting into the portfolio, and even when that is mathematical in nature, it again brings in consistency into the picture and removes the human bias. So if there is energy for that matter, it is undervalued, or utilities for the undervalued. If as a fund manager one makes a mistake of allocating higher capital to one of the sectors which may or may not perform, there is a very big chance of underperformance because of market realities. And the moment I have a mathematical formula where it doesn't allow me to over-index on utilities or energy because the mathematical formula is fixed, there is again consistency coming into picture. So why factor investing works is because of these two primary things, where there is standardization in stock picking, standardization in how much I allocate, how I position size, and ultimately selling. So it's not selling per se; it's basically rebalancing. The way I would put it is there is a rule where the stocks are kind of coming in. Why the stocks come in the portfolio is a rule based, and why the stocks go out of the portfolio as a rules based system as well. So it becomes a very standard way to manage portfolio. And I think if Nifty 50 has delivered as an index, passive index over long periods of time, and actively managed funds are not able to beat it, is because there is a mathematical approach to it in terms of construction of index itself in free float market capitalization perspective. The same way factor is a mathematical approach to it. So nobody can change it, and the consistency delivers returns, in my opinion. The second aspect is we talked about it, where there is a complete elimination of human biases here. These are all mathematical formula based, a price to sales, price to book, coming from a perspective of market reality, and of course some kind of accounting statements as well. One actually is able to eliminate the entire aspect of human bias here. And third aspect, of course, is how I really continually can able to test whether this entire system works or not. So because any kind of factor, one would, before finalizing applying to a strategy, one would look at whether it has worked over long periods of time or not, over last 15 years, 20 years, if it has worked or not. And can I really test it in terms of whether this factor works in bull markets, bear markets, recovery cycle, contractual phase of economy or expansion phase of economy, low liquidity, high liquidity environment. If I can test all these things and there is a sense of consistency coming into performance in terms of beating a benchmark or earning some kind of risk adjusted return, then I know that this formula can be relied upon instead of going with the human kind of bias in managing the money. So I think these three things, where the selection is rule based, management is rule based, exit is rule based, free of human biases, and finally the ability to test whether that works in different market cycles or not, can actually allow us to pick up a consistent formula to investing in life. And I think factor-based funds actually one of the best ways to automate that job and not really rely on me being a retail investor manage my money. Yeah. So how do we look at positioning value based factor fund, or value as an active theme, or picking value stocks on my own as an investor? I think as even Anish mentioned, and I think Shankar and Anish had a long talk where we understood how ultimately no factor continues to perform in all periods of time. We looked at last 2 years itself, where we saw quality actually performing pretty well in initial part of when we coming out of pandemic in March 2020. 2020 was all about quality and momentum. And again, in I think last 6 months, we look at low vol and quality has performed really well. And and if you look at this for over last 15, 20 years, the same thing is bound to happen. There will be times where liquidity will be kind of flush in the marketplace. A lot of risk on environment will come into picture. People will be allocating more and more monies to equities. I think the market changes, and what kind of stocks attracts money will again change that point of time. So momentum may perform at certain point of time, and suddenly there is a liquidity freeze in the marketplace or risk off environment, some kind of geopolitical situation completely out of control of India as an economy or you as an investor. Some other kind of theme may work, and it may be value that point of time. And because we invest over 7 to 10 year cycles, or maybe more in life, and not like just 2 years, 3 years, it's always better that one combines multiple factors into the portfolio. Now, whether you combine multiple factors by going active and passive, and rely on fund manager and passive based approach, or you say a passive one factor, which basically combines best of active and passive together. Allocating money to different factors actually can give you a good steady performance and maybe market beating performance over long periods of time. So whether you do a mix of quality, momentum, or you do a mix of low vol and value or momentum, I think it depends on risk appetite of the person and investment objective as well. But what is important is no one factor can be relied upon for forever to generate performance. One has to possibly look at multiple factors if one is looking at factor based investing beyond passive in life. I think that's about it from my side. Happy to answer questions and kind of engage in a better discussion here.
Thank you, Santosh, for that insightful presentation. And right at the beginning around that presentation, right, you were talking when you were introducing the value as a factor. You said that it is often misunderstood as well, correct? And now at this stage where we are looking, we see that there are a lot of obituaries that are being written all over the internet that value investing is dead. The old principle of buying lows and selling high is not working probably. Warren Buffett is not basically outperforming the index anymore, correct? So do you think this is something similar to the eras of the 1999s or 2000s, where value may be ready for a quick turnaround? Or do you think that this time it is actually something really different and we're in a different regime altogether?
I wish I knew the answer to shit, honestly. As I mentioned towards the end of the presentation, it's very hard to time. We are investing for long periods of time. It's always better that you have exposure towards multiple factors. But if there was a belief that what may happen in the future, one of the things that everybody can possibly sees the geopolitical tension that we are seeing in the global landscape today is possibly far more volatile than we have seen in last decade or so. Be it the China-Taiwan situation, or be it India-China, or for that matter, Russia-Ukraine war, or what your US is going to do about things, or for that matter, how Fed going to tighten the economy or tighten the liquidity there in the US markets. So I think there are multiple factors at play. So if liquidity gets tightened, then I think the first thing which happens is people realize that there is possibly lesser risk reward equation into picture, where one may not be wanting to bet too much on the future and actually look at real performance and cash flows before investing. And you might see a quality and value to coming into fore than actually momentum in that sense, or a growth at any cost kind of picture coming into play. So whether that happens or not is nobody's thing. But I think what is important to know, when the liquidity gets tightened in the marketplace, the money is not as freely available as it was in the past, then I'm sure that's where the good businesses get differentiated from the bad businesses, or the companies with pricing power get differentiated from the companies which are probably riding a wave in that sense. So if that was something which might come true, then we may have a very high chance that value may perform well And what is one more reason is basically value investing by definition looks at companies which have large asset bases, predictable cash flows, or for that matter, a higher amount of earnings possibility in terms of sales at least, or dividend yield for that matter. You by definition going towards quality in some way there. It may be a quality whose time may not be relevant today in that sense, or maybe relevant that is up for the future and debate in that sense. But I guess if liquidity gets tightened, then there is a high chance that value may come to the fore.
Understood. So, so with regards to this performance, correct, there are lots of ifs and buts. When will value perform? When it may not perform as well. And what we can understand is relatively a more cyclical type of story, or the factor is relatively more cyclical in nature, correct? So what should be an ideal investment horizon that an investor should keep in mind before getting into a factor like value?
So I think I think by definition, every investor, when one looks at investing in equity markets, irrespective of factor one picks up, be it momentum, quality, value, low volatility, alpha, or anything else, or size for that matter, one needs to have at least 5 to 7 year horizon. Nothing can be predicted over next 2 or 3 years. And by definition, when you're investing in equity markets, you should not be looking at less than 3 to 5 year horizon in that sense. So I would say that a 5 to 7 year horizon is an ideal one for at the minimum, if not probably a decade before one ventures out in any kind of equity investment. And I don't think value is any different in that sense.
Okay. So with regards to value, correct, we have seen a lot of times when, say, for example, something like the market factor or some of the other factors, when they are not working, value turns out and gives this very different diversifying angle to the entire picture, correct? So from that sense, what would you suggest? Does value construe as a major or as a core portion of your portfolio, or would you rather keep it as a satellite allocation into your overall bucket?
I think, at ET Money, when we work with our investor base, which is completely DIY in that sense, we actually focus more on the asset allocation than actually what kind of factor one should be overweight or underweight in that sense. So once you get your asset allocation right, I think it's more about what kind of volatility you can digest in the portfolio, and I think that kind of volatility that you can digest first governs what kind of allocation one should have. And if value is something which is more cyclical in nature, then by definition it gets lesser weightage to people who are less conservative, and I would rather recommend more of quality for that matter, for that kind of investor base. So it all depends what kind of equity component you're having in the portfolio first, and what kind of volatility one can digest. But I think in investments, when you keep things simpler, possibly that tends to give you better results over complicating things. So if one is wanting to keep things simple, then an equal way towards a quality, value, momentum, and low vol may give a better performance over a longer period of time than actually trying to be too picky about getting the timing right for a factor.
Okay, understood. So the overall idea still is that factors can relatively not be timed, and the better idea would be to diversify across all of these factors. So into your own process, correct, are there any couple of factors or a combination of factors that you normally recommend to your investors, or you normally recommend per se, or do you generally recommend a one by n solution where you allocate equally across all of these factors?
No, so in ET Money, we actually first focus on asset allocation, as I mentioned. Once we get that for the customer, we actually focus more about what kind of there has to be probably quality in the portfolio. We believe that one of the more consistent parameters or possibly lesser drawdowns in the portfolio is by sticking to quality. And once we allocate to quality, we we move towards more of low wall and value instead of actually saying that going to one factor completely. So as of now, most of our portfolios actually are more of passive in terms of index and equity, more of equity, debt, and gold. And within that, equity is basically more of completely market cap weighted. We are looking to venture out into things, and what we've looked at backtest is a combination of quality and momentum tends to give a very good performance for somebody who's an aggressive investor, but somebody who's kind of moderate to conservative. I think it depends about getting the factor timing right, which is far more difficult to get in. So I would say sticking to allocating towards all factors is a far more judicious way to invest than actually trying to be timing things right.
So thank you, Santosh. Thank you so much for that presentation and this conversation. And with that, I think we come to the end of this segment. I would like to thank everyone who has joined here and making this event relatively successful. Okay, so we talked about the factor investing through two themes. First was something which was called quality. Right? That means buying things which are right. And the second factor was value, which is basically nothing but buying things at the right price. Correct? And thanks a lot to Santosh, Anish, and Prateek for educating the investors with regards to what these factors are and how you can use them. With that, thank you, everyone. Have a good day, have a good night, and until next time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.